Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Monday, July 13th, 2020, and I am pre-recording this Trading Places Live for Tuesday, July 14th. Futures are currently slightly higher for Tuesday after a late day sell-off on Monday, especially on the tech-laden NASDAQ. We're going to get into all that in a minute. I do want to just quickly go over the agenda. We will start off with the daily market recap. Got a lot to talk about. Big reversal on Monday, especially in technology, software stocks. Most software stocks got hit very hard in the last 2 hours. Then we'll get into talking technically. I want to bring up the materials group, talk a little bit about materials and why they're actually starting to show a little bit of relative strength. And I'll delve a little bit more into the software space and take a look at that group on a short-term and longer-term basis. Then we'll get into scooter movers, a little bit more in-depth look into the materials group, taking a look at some of the areas of materials that have been improving, some of the individual stocks. Then the earnings spotlight, I'm going to focus on the banks because tomorrow, Tuesday, we do see a kickoff in bank earnings. I'm going to just talk about what I'm expecting. I do think that the banks, because they have been beaten up so bad, could provide a lift for the market if for no other reason than maybe just come out with earnings that aren't nearly as bad as what they could have been. This is a group that's been underperforming for a while. So maybe with some news coming out, maybe we'll see a little bit of a lift. We'll talk about that. And then we'll wrap up the show with 3 you must see. A few different types of companies, including one company, small electric vehicle charging equipment company that has been on fire, but did pull back quite a bit on Monday. We'll look at that chart and maybe take a look at a couple of potential entry areas for those of you who are a little bit more risk oriented. All right, before we get into all that, let's take a look at the website at earningsbeats.com. I do want to invite everyone, if you haven't already, please subscribe. We've got a Earnings Beats Digest newsletter. It is completely free, no credit card required. Simply type in your name and your email address, hit the subscribe button, and we will send you our newsletter Mondays, Wednesdays, and Friday mornings, typically before the market opens, and really just give you some more insight into how we approach the market. It may not agree exactly with your style, but maybe you can pick a few things up that we do that will help you in your trading. So again, go to earningsbeats.com, check it out, type in your name, email address, and hit the subscribe button. If you'd like to try our service, you can go through this Join Today button, and there's a $7 charge, but it's fully refundable. So within a week or so, we'll make sure we get you that $7 back, and you'll get 30 days of service to try us out. And the reason I mentioned this today is that Tuesday after the market closes, we're going to have a Max Pain webinar. We do this once a month. We do it 3 days before the third Friday of the month. Third Friday of the month, of course, is when options expire. So we'd love to have you come in, check us out, join us for this webinar tomorrow. I'll give you some of the stocks that you may want to keep an eye on as we head into option expiration Friday and potentially even the week after. All right, let's move on. Take a look at what happened on Monday because it was a big reversal. You can see the Dow Jones actually did cling to a 10-point gain at the close. It was up a lot more than that earlier in the day, but we did have that reversal. S&P 500 down 30, so down almost 1%. But look at the NASDAQ. NASDAQ down over 2%. We were up intraday over 11,000. Or close to 11,000. I think the NASDAQ 100 actually was over 11,000, but we had a big reversal. That is a bearish engulfing candle. It also came on increasing volume. So at least in the short term, that paints a little bit more of a bearish picture on things. And I should also mention too, the volatility index is still elevated. We had the equity only put call ratio this morning or early this afternoon. The equity only put call ratio was below 0.5, and that was the 6th time. It was threatening to close below 0.5 for the 6th time in the last 7 days. And essentially what that means is that there are a lot of calls being bought by retail traders. And usually when the masses get on one side of the trade and feel like the market can't do anything but go up in this case, that's when we get that reversal. So wasn't shocking really to see that reversal in the last couple of hours. And we may have some volatile action here over the next few days. Mid caps performed better than the NASDAQ, but still dropped 1%. Small caps down almost 1% as well. As we look across the sectors, the weakness came in the areas, most of the areas that have been very strong of late. So technology reversed off of its earlier high. We're up around 110, finished down below 106. So it was quite a reversal on technology. Communication services down 2% after gapping up and moving to an all-time high. Same goes with discretionary, big reversal there. And then energy also lagging today. You can see down about 0.5%. But yeah, I mean, when you look across here, energy and real estate definitely been lagging, but technology, communication services, and discretionary stocks have been leading this market. And those were the three groups that, in my opinion, got hit the hardest in those last couple of hours today. 10-year Treasury yield. We did have a reversal. We got up to almost, well, the high was 0.66, a little over 0.66%, but we did come back down and close at 0.64. Couldn't get through the 20-day. We did have that nice little spike back at the beginning part of June, and that coincided with a lot of the stocks that had struggled during the pandemic rising. If you recall, the early part of June when we saw the airlines really making a huge move to the upside, some of the cruise lines, the hotels, and so forth. Well, that ended on June 8th. And the S&P, along with the 10-year Treasury yield moving lower, the S&P and some of the areas within the S&P also moved lower. So getting this 10-year Treasury yield moving higher would be good for a number of areas in the S&P 500, most notably those interest-sensitive areas. Banks, for sure, really could use a pop in the 10-year Treasury yield. And we do have a lot of those banks coming out with earnings starting tomorrow morning. Of course, again, this is Monday evening while I'm doing this recording. So when I say tomorrow, by the time you're listening to this, it'll be today. But we've got banks that'll be on, certainly on watch throughout the day on Tuesday. We'll see what kind of reaction we get to some key earnings reports. All right, let's move on to talking technically. So in talking technically today, what I wanted to do, first of all, if you're at the, if you're just on your dashboard, you can go in and under the member tools over here, go to sector summary. And I'm going to go back 3 months. And I just want to show you the performance over the last 3 months. Technology, consumer discretionary, and communication services. When we were going over the action on Monday, I just told you those are the three areas that have been the best area. You might not realize it, but materials now have snuck up into that fourth spot and starting to create some distance between them and the rest of these sectors. So you may not realize that materials have been doing as well as they have. But when you go into the sector summary, you can kind of look and get a little bit of an analysis from a relative strength standpoint. It's a little different than using price relative. It's a little different than using scooter. Although if you look at scooter, you can see these four that have the highest percentages also have the highest scooter scores. Now, industrials, you can see the next one up, the scooter's all the way down at 22. So, and consumer staples, which is way down here, still has a scooter of 64. So it's not perfectly set up. The scooter isn't perfectly set up with performance. And you have to realize scooter also looks back at a different period than just 3 months. So that's one of the reasons why you're going to see a little bit of disparity. But for the most part, this kind of lines things up. So if you're looking at the sector summary, you will get perspective as to relative strength and relative weakness. Clearly, utilities, real estate, consumer staples are down at the bottom. And that's generally a good thing when the market's trying to break out like the S&P 500 did earlier today. When you've got defensive groups at the bottom and you've got aggressive groups at the top, that's normally a pretty good sign. That to me is suggests that this bull run is very sustainable. Doesn't mean we won't pull back, but I do think that we're going higher eventually. We may consolidate. It may even be the whole summer. Who knows? We'll have to kind of evaluate things as they happen. But I do believe the stock market is going higher, not lower. All right, so let's keep looking at, so what impact? I mean, why are materials starting to perform better? Why are they up in that fourth spot? Well, one of the big reasons is the US dollar. Now, I'm going to annotate this and just show you, and I've talked about this plenty of times, but for those of you that might be new to the show, when you take a look here, you'll see this is the chart. This is a 20-year weekly chart of the US dollar. And I think it's pretty clear we've got an uptrend in play. When I get 1, 2, 3, 4, 5, 6 different tests along a trend line, that's a pretty solid trend line. So I think it's pretty clear to me anyway, over the last 9 years, we've got an uptrend in the dollar. Short term now, it's been very volatile ever since the pandemic kicked in back in March. We saw a big move down, big move back up, and now we've moved all the way back down. But we've had multiple lows down around 94.5 to 95, and that's right about where the trend line comes in. Now, we closed on the dollar at 96.39. So let's see whether or not we can hold 94.50. I believe we will. I stick with the trend until the trend is broken. So I believe we say that the dollar goes higher. Now, why does that matter? Well, let's move on. Let's take a look at, I'm going to add a couple things to this chart so you can see how I do this. If you go down to price, then you can see the default is the S&P 500, but I want to compare the XLB to the S&P 500. So that's materials divided by the S&P 500. We want to just look at, do they underperform, do they outperform, and what's the relationship with the dollar? Well, let's go ahead and put this on a solid line chart. Set the height to 1 so it'll be nice and large that we can see it. And then I'm also going to do the same thing with energy, because energy and materials both are impacted by the direction of the dollar. And I think you'll see that pretty clearly on this chart. So now let's go ahead and pull this up and see what we've got. Actually, I'm going to make this a little bit taller. Okay, so now I'm going to annotate. And what I want you to be able to see here is we'll go back, mark this trend line. All right, and then we also could mark, I don't know that I'll show a trend line, but you can see that we've definitely got it down. The dollar was moving lower in the first decade of this century, and now over almost the last decade, we've been moving higher. Now, what does that do for materials? Well, when the dollar was dropping back in the first decade of this century, I think it's pretty clear what materials were doing. They were outperforming. So here you can see outperformance. As long as that dollar was moving down, materials for the most part outperforming. Then we went through this consolidation, this little transition period, and then started to turn back up on the dollar, and we went down on materials. But also energy, same thing, going up while the dollar was going down. Go through this transition period for a couple of years, and then the dollar set a bottom and started rising. And what happens to materials and energy? They go lower. So this is the importance. This is why we want to watch the dollar. We want to know whether or not the dollar's in an uptrend or a downtrend. When it's in an uptrend, as long as it remains in this uptrend, we want to be really careful with materials. But materials have been showing strength as the dollar's been pulling back. So in order to be prepared, I would be looking to see what kind of stocks or which material stocks are starting to show a little bit more strength and maybe have higher scooter scores in the event that the dollar breaks down. Then you'll be ready to go. So that's something, and we're going to look at that in just a minute when we move to the next segment. But before we get to that, I do want to let's just get out of this. I do want to go in and talk a little bit about software. Now, software has been one of the best areas of the market for years, many years. We've had some pullbacks. You can see most notably fourth quarter of 2018, and also when the pandemic hit, February into the middle part of March. Pretty good moves to the downside. But other than that, when you look back over the last 5 years, for the most part, we've been going higher. And off of that low in March, software stocks exploded to the upside. Today, we were down 3.6%. Now, this is a long-term weekly chart. And you look at this candle and you think, wow, it's just a blip on the radar. It's okay. you know, we just pulled back a little bit. We're still in a nice uptrend. PPO's very positive. The 20, we're well above the 20-week EMA, well above the 50-week SMA. You know, there's nothing really to worry about here. That's what you think from a long-term perspective. Now I'm going to shorten this down. Let's take a look at the daily chart. Daily chart, all of a sudden, that 3.62% drop looks a little bit bigger. We've just taken out gains from the last 6 days, or we basically, you know, we were near the high, all-time high, and by the time we closed, we were back where we were when we started July. So any gains that we've had in the month of July went out the door in the last 2 hours today. So here, though, we're still above the 20-day moving average. You know, still looks pretty good. On this last push to the upside, the PPO was starting to rise again. So weekly still looks great. Daily still looks okay. Let's go to the hourly. Now, all of a sudden, you look at the hourly chart, and this goes back a month, and I think it's pretty clear to see we've got a breakdown. So short term, we've got maybe a little bit of issue. I mean, there was your prior low after a day of selling. Here was your gap support. This is where we gapped up on July 6th. So we went back there. We went below both of those levels. So where do we go from here? Well, there's a couple thoughts here. The first one would be the breakout level, which was right there. That was the prior high. We went back, pulled back, and then we broke out. And even one time came down and tested this area. So that's 38.30. So we're talking about maybe 20 points to the downside. I think if we don't hold that, then I think the next level probably becomes somewhere around this 36.70 area, or maybe we could even go down to these lows. I'm looking over here after this gap up. Maybe that low right here on June 29th, and then maybe this low right here. So that could be the next range if we don't hold this 38.30 area. We'd be looking at maybe another 200 points lower, which would be another 7% or something from where we are, 6%. So that's, you know, definitely something to keep in mind, but it just goes to show you different perspectives come up with different thought processes on what's going on in the market and in a particular area. So weekly looks great. Daily still looks okay. Hourly looks weak and poor. Look at this 10-minute 5-day chart and look what happened today in just a little over the last 2 hours. So here was our slow, steady progress up for 5 days. And literally in 2 hours and 15 minutes, it was all gone and then some. So daily, or the intraday chart, really does not look good at all. Pretty bearish information here. I still like software, but this group has run a lot, and there's a lot of really good earnings already built in. The market is anticipating blowout earnings for these companies. It's very possible just the fact that we're anticipating strong earnings, we've already set a high, and we may pull back. Maybe when the earnings come out, we make one more run up here at the top. We just may need to consolidate over the summer. And that would not be a shocker at all, given what has happened with software. It may be a situation where the weak pandemic stocks begin to lead for a little while, just like they did back in mid-May to mid-June or early June. All right, let's move on. Scooter movers. So we talked about materials, and I thought what I would do is let's go over. I want to show you how you can kind of get a sense of what's going on in materials. So I'm going to go to the scooter reports, and let's do, how about a 1 week? We'll do the percentage change or the scooter change, but I'm only going to do materials. All right. So as you go down and you look at these are the stocks that in the material sector have had the biggest change in terms of the scooter score. Now, I do need to clarify this a little bit. When you type in materials, any materials anywhere is going to come up. So you can see here, there were a couple of industrial sector stocks that were pulled up. Why? Because they had building materials. Materials was in the industry name. There are others. Here's some, again, building materials. There's also one down here That's a technology, a semiconductor. Why is that on here? Applied materials. So when you type in materials in that box, just remember materials can be anywhere. Doesn't have to be the sector. But trying to focus just on materials, I thought I'd pull up just a few of these stocks real quick. Air products and chemicals. This is one that's already broken out. It's in the material space. So just imagine if the dollar breaks down and materials actually start to take off. Air products would be one naturally that I would be looking at. Others on this list, we had FCX, which is Freeport-McMoRan. That was a reversing candle today, by the way. That is a shooting star candle, a false breakout above 13.5. I'd be a little nervous with this stock in the near term, but it has been a leader, and eventually certainly could be a great stock if materials do lead and the dollar breaks down. Maybe one other one that I'm going to pull up. About FMC. This one's got a little bit lower scooter score, but after getting close to that double top from February, we've just simply been sideways consolidating. I see almost equal highs, rising lows, a little bit of an ascending triangle. A breakout above 105 would actually measure up to probably about a 117, which would be a breakout above that double top in February. So FMC is another one I think is looking pretty good. Now, I wouldn't rush into these stocks right now because, again, we have to remember the materials are not a great group right now. They're improving. They need the dollar to break down. So this is not a group that I would be moving into. And if I did, I would have tight stops. So like the breakout on APD, I'd want to make sure that if that breakout doesn't hold, I get out. Why? Because materials are in a 9-year downtrend relative to the S&P 500. So if the dollar starts to move back up again and materials underperform, last thing you want is a material stock that fails to hold a breakout. So keep that in mind. All right, earnings spotlight. Let's move on to the banks. We got a bunch of earnings coming out later this week, but I really just want to focus right now on the banks. Let's pull up JP Morgan. I'm going to go through all of these and just give you a quick synopsis of what I think, and then we'll move on to 3 you must see and wrap up the show. JP Morgan starting to turn back up again, actually finished higher today, which was good. It is a pretty good stock relative to the banks, but banks just hit a 52-week low versus the S&P 500. That's why I was saying maybe we get a little bit of a rally on a relative basis like we did in May and June. I don't know that banks are going to go screaming higher, but maybe on a relative basis we get a little bit of a bounce. So we've got this trend line that definitely is lower, but maybe we get a little bit more relative strength here first. If we do, then JP Morgan, I think, looks pretty interesting. Also looking pretty interesting would be Citigroup. When you look at Citigroup, look at the relative strength here versus the banks. It was up near a 52-week high just 1 or 2 days ago. So coming off the 50-day moving average, it was down a little bit today, so it underperformed JP Morgan, but I really like the relative strength here. So if banks make a run, I think that Citigroup is one you may want to keep an eye on. Wells Fargo. Are all banks created equal? The charts say no way. Wells Fargo relative to the banks down at a 52-week low right now. Look at this stock trading below its 20, which is below its 50. Completely different setup here. I do not like Wells Fargo heading into earnings. How about Bank of America? Bank of America getting back above both moving averages. Look at the relative strength here. Very strong. So I put this one right up there with Citigroup. How about PNC? PNC was a leader in banks for quite a while. You can see this whole thing going up, and in May was at a 52-week high. Something's going on here, though. Last 6 weeks, it has been trending lower on a relative basis, and it's also below its 20, which is below its 50. I don't know. This one, I've been a fan of PNC until probably the last couple of months, but it doesn't look very good to me here. FRC, this is a bank out in San Francisco, I believe. Yes, First Republic Bank, San Francisco. This one actually set a 52-week high back in early June. So this is a stock that relative to the banks has been doing very well. Maybe not as well known and maybe not quite as big as some of these others, but FRC looks pretty good to me. And then the last one I wanted to bring up is Regions Financial. which we'll be reporting later this week as well. Regions did hit a 52-week high in mid-June, but has since pulled back. And while it's pulling back, you can see trading below its 20 and its 50. The 20 just got a death cross below the 50. I don't know. This one's a little tough. I think, again, looking at the banks, the ones that would probably interest me the most would be JP Morgan, Citigroup, Bank of America, and that First Republic, San Francisco. Those are the four that I think of these seven look the best technically. We'll see what happens when the earnings come out this week. All right, let's wrap this thing up with three you must see. I'm going to start off with PAYC. This is a software company. And the reason I'm bringing it up, we got right up to that February high. A lot of software companies went through the earlier highs. Paycom has not. So on a relative basis, you can see Paycom never got back up to the high that it set on a relative basis. And now it is trending lower. And it also just broke down below these two lows, and it broke below its 50-day moving average. Volume was just so-so. It did look like it was picking up a little bit into the day. I would want to see a reversal on PAYC Tuesday. If I didn't get a reversal, I would be out of the stock. I just don't like the fact that it is closing down here below these prior closes. It really needs to reverse at this level. Next stock up, and this is the one I was referring to earlier. This is Blink Charging. This is a company that provides EV charging equipment. A lot of these EV stocks have been on fire. This one is no exception. I believe it's maybe $160 or $170 million company. So it's a very, very small company. But it was one that went from 2.5 to 8.5 in about 6-7 trading days. It's come all the way back down into the fives. 5.99 was closed today. Watch that 20-day moving average around 5. If we go below 5 and then come back up through the 20-day for really folks that don't mind taking a additional risk, I think that would actually be the opportunity to jump into Blink. So this one isn't for everyone, believe me. And if we lose the 20-day, we could go back and test this level, the breakout and this gap support zone back in the low 3s. So, when you get a stock that goes from 1.75 to 8.5 in 5 weeks, you have to be prepared for a lot of volatility. So this is definitely a volatile stock, not for everyone. Make sure you're comfortable taking the kind of risk that you need to take in a stock like this. But a reversal off that 20-day moving average would be the first thing I'd be looking for. All right, last stock I wanted to mention, last of the three you must see, Maxim Integrated. Now, it did sell off after it opened higher today, but look at the volume off the charts. And let's take a look at the weekly chart. You see all of these tops coming in here, into the low 60s. We actually gapped up, opened at 72 today, did finish back down in the upper 60s at 69 and change. But I think we got the breakout already. Huge volume. This is a weekly chart, and this is just 1 day's worth of volume. And it's heavier than any week that we have seen over the last year and a half or more. So a lot of volume coming in, big gap up, pulled back. But I think if you get back into that gap support zone, this is a stock that certainly could turn back around and go back higher. All right, that is it for today. Appreciate everybody stopping by. Good luck today, and happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.